Welcome to RSM Tax Summit Week 2021. Today's presentation is Canadian Income Tax in 2021 and 2022. At this time, I'm pleased to turn our call over to our first presenter, Clara Pham. Clara?
Thanks, Allison. So this year was very much a year of reckoning. Pandemic, an election, a massive and growing national debt, and all with an overlay of competing priorities such as economic recovery, business going digital, tax and social fairness, environment, and technology. So today, our presenters will attempt to make sense of it all, and will cover the salient Canadian income tax developments of 2021 from the perspectives of business tax, M&A, international tax, the COVID programs, and audit trends. Just before we kick off our discussion, let me briefly introduce our panelists. Michael Bancroft specializes in business tax and brings a combination of practical experience and tax acumen from across multiple tax practice areas. Stephen Rupering specializes in integrated Canadian income tax advice with an emphasis on complex tax planning engagement, tax diligence, and buy-side, sell-side tax advisory. Austin Ramsey specializes in international tax compliance and consulting services with an emphasis on inbound and outbound international tax consulting services. And I'm Clara Pham. I specialize in domestic and cross-border corporate income tax and lead RSM Canada's tax thought leadership practice. Over to you, Michael, to take us through updates in the business tax space.
Thank you, Clara, and thank you everyone for joining us today. As Claire said, I'll be taking everyone through the business tax measure updates of 2021, as well as those proposals that we're tracking from the federal budget, and we'll be looking to see what happens in 2022. So the key business tax measure enacted in 2021 was the changes to the employee stock option rules. Now, we've been following these different iterations and these proposals for 2 years now, as I believe they were first proposed back in 2019, and now they've become law and effective as of July 1st, 2021. The purpose of the new rules is they're targeted at high-income individuals employed at large, long-established corporations. So they don't necessarily replace the old rules. The old rules are still in place should your employer qualify under the old regime. They simply layer on new rules for certain employers that meet that criteria. And what is the criteria? And so the new rules apply to non-CCPC employers with annual corporate group revenue greater than $500 million. Now, when I say non-CCPC, I mean employers that are not Canadian-controlled private corporations. So those entities that are controlled by public companies and non-residents, or a combination of both, as the first criteria. And then the second criteria is that corporate group revenue is greater than $500 million. Now, a key aspect here of the criteria is that the consolidated group revenue is at the ultimate parent entity level. It's not a Canadian consolidated group revenue threshold. It is measured at the ultimate parent entity. So it is based on the consolidated revenue reflected in the last annual consolidated financial statements presented to the shareholders or unit holders of the ultimate parent entity of that group. So for example, if a U.S. public company has wholly owned Canadian subsidiary employers, you would be measuring the total consolidated revenue at the U.S. public company level and not just at the Canadian corporate group level to determine if these new rules apply. Conversely, if you are a Canadian-controlled private company employer, or you're a non-CCPC with corporate group revenue at the ultimate parent entity level of $500 million or less, you're still subject to the old stock option rules. So what does that mean to both employee and employer? So let's start with employee. And just to recap, to level set here, is that historically, stock compensation in Canada has been taxed favorably at the employee level, in that if certain criteria are met, for example, it's an issuance of a prescribed share, generally a common share, and also, if you're a non-CCPC, the options are not issued in the money, so they're issued at fair market value, then a stock option deduction is available, and essentially the employment income is taxed at 50%. So favorable treatment of employee stock option plans historically in Canada, and these new rules set out to limit that benefit. So if your employer if the rules apply to your employer, 50% of the employee deduction is subject to a $200,000 annual vesting limit. And that annual vesting limit is based on the fair market value of the underlying shares on the options grant date. So what does that mean? It really means that 50% deduction that was given to all stock options issued before is subject to a $200,000 threshold. And the easiest way to kind of walk through that is just to go through a simple example. So employer grants 8,000 options on November 15th, 2021. So after July 1st, 2021, when these rules come into play, and 4,000 will vest in 2022 and 4,000 will vest in 2023. The fair market value of the underlying shares on the grant date, which is the key date, are $100 per share. So what does that mean? What percentage of stock options are subject to the $200,000 annual vesting limit, and which ones will be non-qualifying securities whereby the stock option deduction will not be available? So in 2022, we have 4,000 vesting. We've got 2,000 of 4,000 of those options will qualify for the 50% employee deduction, because 2,000 of the options is a $200,000 value limit at $100 per share. Again, in 2023, the other tranche of 4,000 options will vest, and again, 2,000 of those options would qualify for the 50% employee deduction. Also to note for employees is that it's based on vesting in the calendar year. There's a $200,000 annual vesting limit per employer, unless issued by a related group. So for example, you work for two entirely unrelated public companies in 2021, and you're granted stock options from each of them. Each employer is subject to its own $200,000 annual vesting limit. And also another thing to note is that in stock option agreements, the vesting date is not always specified. Sometimes it is, there needs to be an occurrence of a specific event or a performance measure met in order for those stock options to vest. In that scenario, the stock options would vest pro rata over the course from the grant date to the last date in which those stock option units could be exercised, not exceeding 60 months. So that's how that vesting period would be determined. It would be pro rata over that term to determine when and where the $200,000 annual vesting limit is applicable. Moving to the employer implications. So historically, the employer implications for stock option compensation, and ignoring any kind of cash out or anything like that. In your plain vanilla example, is that a corporate tax deduction was not available for the stock option benefit received by employees under the old rules. Now, with the change to the new regime for certain employers, a corporate tax deduction is available for the portion of employee stock option employment benefit not subject to the 50% employee stock option deduction. So over that $200,000 annual vesting limit, employers will now get a corporate tax deduction. But in order to qualify for that corporate tax deduction, there are notification requirements that must be met. So employers must notify employees within 30 days of granting an option on a non-qualifying security, and they will also have to provide notification to the CRA via a prescribed form, which we don't have the details of at this time, but that will be due with the annual tax filing on or before the annual tax filing due date. So if you're a non-CCPC, your tax returns due 6 months after your year end, this prescribed form would be due alongside that tax return. And an important note here is that it is the employer, not the grantor, that's required to file this notification. So often we see, a related corporation in the group is the actual one who is issuing the option units because it is the entity that's traded on a public market and not the actual employer that is the issuer. It is the employer that is required to meet these notification requirements. In addition, employers will also be given the option to elect to designate shares that would otherwise qualify for the 50% stock option deduction to be non-qualified and take the full corporate deduction on the full stock option and benefit to those employees. So again, that stock option benefit would be deductible on exercise by the employee when it is included in the Canadian employee's income. So a benefit here in the new rules conferred to the employer for the portion above $200,000, but also for the whole amount should they choose. So what does that mean in terms of next steps as we come up to December 31st, 2021, which, popular year end and stock options are being issued under this new regime. That's going to require employers to review stock option plans, grant documentation to accommodate designation of non-qualified securities, and meet the employee notification requirements. Processes are going to need to be implemented, perhaps modified, payroll systems to track option grants, vesting periods, non-qualifying security designations, and employee option exercises. That's going to be needed to track when the corporate tax deduction is available, as well. It's going to have, tax provision implications for year end as well, as, employee stock comp won't be just a simple permanent difference anymore. The other thing is, looking at stock option agreement and evaluating vesting periods. Is there a way to structure them to come under for your employees under this $200,000 annual vesting limit, and also, modeling out the tax benefits between the corporation and employees. So these are items that are going to have to, attention is going to be paid as we come up to our most popular year end here of December 31st, 2021. On the look ahead, as we look into 2022, we highlighted 3 key measures that were included in the federal budget proposals. They weren't enacted into law, but with a re-elected Liberal minority government, we're tracking these proposals to see how they progress. And whether they actually get enacted into law. So the first key one here is tax depreciation for CCPC and immediate expensing. So this one is, quite an attractive incentive for small and medium enterprises with a $1.5 million immediate expensing limit on capital property purchases, excluding long-term property like buildings or, intangibles with indefinite life. The $1.5 million is in addition to all the other existing accelerated investment incentive, fast track of CCA. And one thing to note is the CRA has come out recently that said this, you can't claim this on tax returns until the legislation is introduced. The next measure we're tracking is the corporate tax rate reduction for zero emission technology manufacturers. It was proposed to take the federal tax rate from 15 to 7.5% for those subject to the general corporate tax rate, and from 9% to 4.5% where the income is subject to the small business tax rate. Additionally, under the environmental theme, we've got expanded, accelerated CCA deductions for certain clean energy equipment. So they're expanding the eligible capital cost allowance for classes 43.1 and 43.2 to include certain clean energy equipment. So another budget proposal to encourage investment in Canadian and provide cash flow and tax deferral, especially for those that are operating in the manufacturing industrials industry, that we'll be watching and keeping track of to look ahead in 2022. And with that wraps up the update for the business tax measures. So I would like to pass things on to my colleague, Stephen Rootnarain, for the M&A tax update.
Thank you, Michael. As we move into the M&A tax updates, the way we've structured this section is we're going to look at some of the cases that have gone through the court system as they pertain to transactions of interest that have occurred during the year. And then we're going to look at the legislative response to those decisions and how it may have impact going into the future. So we'll start off with Eyeball Networks. But before we get into the case, a little primer on Section 160. So Section 160 under Canadian domestic income tax legislation is a collection tool, effectively, that allows the CRA in certain circumstances to assess one taxpayer for the liability or the tax debt of another taxpayer. As you can imagine, that could be a very widely used tool. So of course there has to be some hallmarks that are present in order for them to be able to access Section 160 as a collection tool. So the principal hallmarks are there needs to be a transfer of property between those parties. The parties themselves must be found to be acting at non-arm's length, so related parties. And the transfer needs to have occurred at an amount less than fair market value. So essentially, it's a discounted transfer. So the policy reason for this particular collection tool is to prevent taxpayers from effectively transferring assets away from where the tax debt is, such that the legal taxpayer who owes the debt no longer has the assets or the ability to satisfy the tax obligation. So this tool can then be used in order to follow the assets effectively to where they landed and then assess that taxpayer for the tax debt of the original taxpayer. So in Eyeball Networks, the parties undertook a very common transaction in Canada, which is effectively a tax-deferred carve-out. So provided that you stay within the CRA guidelines, corporate taxpayers in Canada are allowed to split up their businesses on a tax-deferred basis. This is often used in the context of a carve-out transaction or where shareholders of one target enterprise wish to divide the business and go their separate ways. In this particular instance, they implemented such a transaction whereby the assets of the target company were transferred to a new company on a tax-deferred basis. Subsequently, the original target company or the transferor of the original assets was assessed a tax debt. Since it had transferred all of its assets to a new company, it had no assets remaining to satisfy the obligation, the tax obligation. As a result, the CRA assessed 160 to go after the new company to which the assets had been transferred related to the tax debt of the old company. Their position was that at the time of the transfer, the old company did not have any value, and therefore the transfer occurred at less than fair value. In the finding of the court, they looked at the provisions and said, no, we disagree with that at the time of the transfer, the old company effectively had all of the asset value that it needed in order to effect the transfer. Therefore, you cannot look at the position of the old company immediately after the transfer when the assets are no longer there. You have to look at it at the point in time at which the transfer occurred. Again, this is very common when we're looking at split-ups and carve-outs to implement this type of planning. So we'll have to consider going forward if there are any risks to this type of planning, particularly from a diligence and transactional perspective, as there may be a company outside of a transaction perimeter or outside of the transaction perimeter that has undertaken this type of planning to which the CRA could go, and if there's no ability to satisfy the tax obligation in that company outside of a transaction, they may be able to go to a company now that is inside a transaction perimeter and seek the tax liability there. So we'll have to look at how this evolves. Again, they were not successful in court, but we'll see the legislative response to this in a moment. The next case, which is Damos Properties, actually goes the opposite way. So in the last case, we looked at a situation where we had one taxpayer that transferred away its assets and then did not have the ability to satisfy a subsequent tax liability. Here we're going to look at a situation where the transferor that received the assets did not have the ability to satisfy the tax liability, and it went back to the original transferor. So Section 160 can actually go both ways. In the context of this transaction, what we had here was farmland, which was transferred into a subsidiary corporation. The farmland was then sold by the subsidiary corporation, which triggered a substantial tax liability in that subsidiary corporation. Immediately after the sale, the shares of the subsidiary corporations were transferred to another third party that had sufficient tax shelter to absorb the tax liability related to the sale of the farmland. That third party then used the cash in the subsidiary corporations received on the transaction to settle the amount owing to the original owners. CRA attempted to assess this transaction on two principal bases. One was that the parties, being the third party and the original owners, were not in fact acting at arm's length, that the third party was an accommodation party in respect of the true transaction, which was the sale of the farmland. And therefore, because they were not acting at arm's length, the CRA could apply Section 160. Since the third party did not have a tax liability because of the tax shelter it had available, the CRA used 160 to go back to the original owners and assess them the tax that would have been otherwise owing had they sold the property directly without the third party intermediary. They then said that if Section 160 doesn't apply, then the General Anti-Avoidance Rule, or GAR, should apply to the series of transactions, just on the face of it being offensive. The courts found that the CRA lost on both arguments. With respect to the third party transaction, they indicated that the third party effectively was not related to the sellers, the original owners, in any way. The third party had its own economic interests. It had its own business, which it had generated substantial shelter and losses from. So the use of those losses was not restricted to that third party. And they also found that it was a fair value sale. So essentially, the subsidiaries were sold for a price that was slightly higher than the after-tax value had the subsidiaries been subject to tax on the transaction. So in their estimation, the transaction did occur at fair market value, and there was bargaining that occurred between the third party and the original owners to arrive at a suitable price. Again, you can imagine that the CRA did not like a transaction being undertaken where losses and shelter of another taxpayer were able to be accessed on the sale related to a transaction that is not in the normal course of their business. So how did they decide to try to address these loopholes or perceived loopholes? So the response was essentially an expansion to the tax debt avoidance rules in the Act. And these are proposed at this stage, but we do expect that we're tracking them, but it's likely they will be enacted. So the first one is arranging for a tax debt to crystallize after the end of the taxation year in which the property transfer occurs. And how they will address that is by deeming the tax debt to have arisen in the taxation year in which the property was transferred. So this addresses the Eyeball Networks transaction directly. So if the tax debt is deemed to have arisen in the year in which those assets were removed from the company, then it essentially allows the CRA to assess 160 to either company or to either party to the transaction. The second adjustment or amendment that they're making is arranging for the transferor to be dealing at arm's length with the transferee at the time of the property transfer. So again, this is addressing the Damos Properties transaction where the parties were found to be acting at arm's length. So this widening of the rules will essentially support a CRA assessing position where there is, where the parties are not related. It will allow them to be it'll allow the CRA to deem them to be acting at non-arm's length where certain hallmarks or facts are present. And what those facts and hallmarks are at this stage is unclear as to how they're going to determine that, but they're clearly looking at these types of transactions where third-party shelter is being accessed. And the last one is where there's a stripping out of the net asset value using a series of transactions that does not breach the point-in-time valuation test. They will have the ability to redetermine the values based on the overall result of the series of transactions rather than using the point-in-time valuation test. So again, this is the eyeball network situation. You can't look at the asset value at a point in time, but you'll look at the asset values of the respective companies at the end of the series of transactions to determine whether or not any value was transferred. If you're found to be into an abusive situation with respect to a tax debt avoidance scheme, then they're also proposing to levy penalties for planners and promoters of these arrangements equal to 50% of the tax that is attempted to be avoided, or $100,000 plus the planners or promoters' compensation for any tax avoidance schemes. The next case that was of interest, which has actually recently come out, and we'll be watching closely the appeal, is with respect to a recharacterization of capital gains to dividends. So in Canada, there's a material difference in the taxation of capital gains versus dividends. Capital gains are only subject to 1/2 tax. So generally in a corporate or personal circumstance, you're looking at between 24 to 27%, depending on which province you're resident in. And with respect to dividends, you may be looking at anywhere between 39 to 48% with respect to a dividend. So what often happens in transactions is parties are looking, or sellers are looking to obtain capital gains treatment on any proceeds that are received. In the Poit transaction, in the context of this transaction, there was a material amount of excess cash in the target companies to be sold. Normally, most deals are completed on a cash-free, debt-free basis, meaning that the cash has to be extracted from the company prior to sale. If the cash is extracted prior to sale, that normally happens by way of a dividend payment, which carries a higher rate of tax, as we just discussed. In the context of this transaction, the parties agreed to leave the cash in the business and effectively increase the purchase price for the additional cash that was left behind. The buyers then financed the portion of the purchase price using the cash from the business once they had completed the acquisition. The CRA did not like that. They felt that the cash that came out should have been a dividend. And in that context, they used subsection 84.2 to reassess the taxpayer for the cash component of the proceeds in respect of the excess cash that would otherwise have been a dividend in their view. So 84.2 generally deems a shareholder to have received a dividend if there's a distribution of property from the business directly or indirectly in certain circumstances. Those circumstances are limited to the wind-up, reorganization, or discontinuance of a business. So in the context of this sale transaction, the CRA took the position that the company was being wound up or reorganized, and therefore an 84.2 assessment was possible. They were successful at the court level. This was challenged. They were successful with the 84.2 assessment at the courts level, and the decision has now been appealed. The application of 84.2 is always a concern whenever we're doing a transaction on the sell side, and there is property being distributed from the business either directly or indirectly as part of the series that includes the transaction. However, historically, the courts have found in favor of the taxpayer with respect to any 84.2 attacks. So it will be interesting to see if this decision is appealed and overturned. Otherwise, this will be something that will be of interest to taxpayers going forward, particularly as they have to clean up or purify businesses prior to selling them to arm's length buyers. The Deans Knight Income Corporation case dealt with the acquisition of control provisions as they pertain to transactions occurring in Canada. So in Canada, wherever there is an acquisition of control, that's critical for many provisions in our domestic legislation, including, most importantly, is the streaming of certain tax attributes, for example, losses, capital losses, SR&ED pools, ITC pools, etc., may be subject to restrictions in the event of an acquisition of control. So historically, the guidance has been very clear on whether or not an acquisition of control has occurred. The tests have been numerical, and they've been based on voting control changes and fair market value changes that can be computed. Deans Knight has tossed that up a little bit in the sense that the courts found that an acquisition of control has occurred if a person or a group of persons has acquired actual control over the corporation's actions, whether by way of de jure control, which means control of the voting shares, or otherwise. And so the or otherwise has created a lot of cause for concern because it opens up what was, excuse me, what was historically thought of as relatively certain jurisprudence has now opened it up to some level of interpretation. So it now casts a broader net and requirement of additional analysis where we have transactions and it's not necessarily clear if there's been an acquisition of control, even though voting control may not have been acquired. So for instance, if we have a minority investor, but they have veto rights with respect to certain decisions that the company is able to make. If we have a debt investor, but the terms provide for effective control through board seats. How do we now think about these types of arrangements, and do they in fact trigger an acquisition of control event? So we expect that there will be continuing, evolution in terms of the thinking on this, and whether or not the courts choose to refine this or revert it back to the more traditional definition of acquisition of control remains to be seen. And finally, we want to wrap up with changes to the mandatory disclosure rules. So as you can see throughout this section of the presentation, there has been a trend, an increasing trend towards scrutiny with respect to transactions and planning that is undertaken for transactions. As Clara mentioned, there's been a lot of spending, and so tax revenue is certainly a way to finance some of that spending. Additionally, some of these transactions are fairly complicated, and so there needs to be additional reporting in order to allow the CRA to even identify some of the more complex transactions that are occurring. So to that end, they've introduced or proposed 5 material changes that would enhance the existing mandatory disclosure rules, which are very narrow and really relate to tax products or promoter schemes or things that are just not very broadly seen in the tax community. So now it's proposing to expand it that will capture a broader array of transactions, including could be even vanilla purchase and sale transactions of businesses. So they'll do that by expanding the reportable transaction rules. So again, those are a very narrow set of rules where a promoter is being used and there's a contingent fee element associated with the tax savings, as well as confidentiality and some type of guarantee with respect to any assessment of tax liability. So those rules are going to be expanded such that instead of requiring all 3 of those hallmarks, you'll now only need to have one of those hallmarks present for the transaction to be reportable. They've also introduced a new requirement for notifiable transactions. So these are basically the CRA will from time to time issue transactions that are of interest to them, that they are looking at, that have come to their attention, and they can then have the ability to classify those as notifiable transactions, meaning that taxpayers will now need to monitor what is considered a notifiable transaction through the CRA releases, and then determine whether or not any transactions they're undertaken meet those requirements for disclosure. Similar to many other jurisdictions, they're also creating a new requirement for corporations to report on certain tax treatments. Again, that's not new for many G7 jurisdictions with sophisticated and tax avoidance frameworks. So we can now expect to see that with respect to any uncertain tax positions, and that will stem from the accounting and assurance reporting. So if for assurance and accounting purposes it's not certain, then it needs to be reported separately to the Canada Revenue Agency. Where we have failed, or where the taxpayer fails to appropriately report a transaction under the mandatory disclosure rules, the applicable reassessment period could be extended in certain cases, which means that essentially instead of the normal 3 to 6 years that the CRA has to make a reassessment, that period would now be extended if the reportable transaction was not properly documented and filed. There's also, of course, imposing substantial penalties for failure to comply with the reporting requirements. So these are, again, in consultation. The consultation just finished at the beginning of this month, so it'll be interesting to see how these rules are going to be further refined. But it is something that, we are making our clients aware of, in the sense of being prepared for increased disclosure, increased audits with respect to transactions that are occurring in Canada. So as we look forward to 2022, it's been a very heavy transaction year in the middle market in Canada. We can expect more transactional activity as we move through the rest of this year and into 2022. So certainly these additional disclosure rules, as well as some of the proposed measures being implemented by finance, are not a surprise, and they are going to likely try to implement these to catch a lot of the transactions that are occurring right now, and be able to look at those in greater detail and perhaps make some reassessments where possible. So it's important that from a diligence perspective, as well as from a planning perspective, that we're paying closer attention to atypical transactions that are occurring, which could fall into some of these new reporting requirements, as it may not be obvious on the face of it that they should, if they're not really avoidance transactions, but they could nonetheless be captured. And with that, I will turn it over to Austin for international tax.
Thanks very much, Stephen. As Clara mentioned at the outset, my name is Austin Ramsey, and I'm a Senior Manager with RSM Canada's International Tax Team. Today, I would like to discuss a few major international tax developments that may impact your Canadian business operations. In particular, these developments relate mainly to measures that address tax avoidance strategies that exploit gaps and mismatches in tax rules between different countries and continue to align the base erosion and profit shifting or BEPS action plan. As a general observation before we get into these rules, I would just generally recommend that companies review their structure, especially companies that have cross-border structures, cross-border financing, to review their structures to see if these rules apply, and then if so, what the intended impact is, and if there's any sort of planning or any structural changes that need to occur. One of the first ones I'll take you through is the interest deductibility limitation. Generally speaking, Canada's tax laws allow the deduction of interest expense if the borrowed funds are used to generate income. However, excessive debt or interest expense may be placed in Canadian businesses that erode the tax base. Canada currently limits the interest deductions on excessive cross-border debt primarily through the so-called thin capitalization rules, which generally limit the deduction of interest expense on debt owing to specified non-residents, where debt exceeds a 1.5 to 1 debt-to-equity ratio. The major shortcomings of thin capitalization rules from the government's perspective are that the rules only apply to debt and interest expense owing to significant specified non-resident shareholders, and also allow a significant degree of flexibility in terms of the rate of interest that a corporation can pay. To mitigate this, Budget 2021 proposed to introduce a new interest deductibility rule that limits a corporation's interest deduction based on a fixed ratio of tax EBITDA, generally understood to be interest expense, interest income, income tax, and deductions for depreciation and amortization, each for tax purposes. And so that's sort of the basis that this interest deductibility rule would be measured against, and it would be a fixed ratio of that. The proposed rules, which also apply to trusts, partnerships, and Canadian branches of non-resident taxpayers, would be phased in with a ratio of 40% of tax EBITDA for taxation years beginning on or after Jan 1, 2023, but before 2024, and 30% for years beginning in 2024. The limits on interest deductions would apply with respect to existing and new borrowings. An entity that is subject to the denial of the interest deduction would be able to carry forward the deduction for up to 20 years or back for 3 years. So from that timing perspective, there's somewhat of a parallel with some of our loss carry forward and carry back rules. There are exceptions to these rules, and these could include CCPCs, or Canadian Controlled Private Corporations, that together with associated corporations have taxable capital employed in Canada of less than $15 million. It could include groups of corporations and trusts whose aggregate net interest expense among Canadian members is $250,000 or less. It is also expected that standalone Canadian corporations and Canadian corporations that are members of a group that do not include non-residents would, in most cases, not be subject to the interest deduction limitation. One thing to note is that it's still not entirely clear how these rules will interact with the thin cap rules, but it appears that these would apply concurrently to the thin capitalization rules, regardless whether a relevant interest expense is payable to a related party or an arm's length lender. In general, going forward, it's important to consider whether these interest deductibility limitations apply to your organization structure, and if so, what the impact is. And generally, it's important to look at whether structural changes need to be made or refinancing, et cetera, to take advantage of or to mitigate the effects where possible. Note that draft legislative proposals are not yet released. The final legislation may look different than the proposed rules. The next set of rules that were announced that I would like to take you through are the hybrid mismatch arrangement rules. Budget 2021 proposed to introduce new rules to address hybrid mismatch arrangement. A hybrid mismatch arrangement refers to an arrangement whereby there's a difference in the tax treatment of an entity or an instrument in 2 or more countries, and the payments give rise to one of a possible range of outcomes. One of these might be a deduction or a non-inclusion mismatch, whereby a deduction is taken in one country but not included in income in another. And these have been targeted heavily by CRA in the past few years. There's also double deduction mismatches, whereby a tax deduction is available in 2 or more countries in respect of one economic expense. And there's other mismatches that are targeted as well, such as imported mismatches or branch mismatches. A number of countries, including the US, the UK, Australia, and European Union member states, have already implemented or committed to implement rules consistent with the OECD's BEPS Action Plan 2 recommendations. The budget proposed to implement the following changes in 2 different legislative packages, taking effect July 1st, 2022, and the second no earlier than 2023. These rules would aim to neutralize the effect of the hybrid mismatch arrangements by aligning the Canadian tax treatment with the income tax treatment in the foreign country. Again, this I'll come back to if we're thinking about the approach that we would recommend here. It's really reviewing your structure to see whether these rules apply or if there's any hybrid instruments or hybrid entities in the structure that could be impacted by these rules and what the effect is, and understand that. The third of the international tax measures that I'd like to take you through is the digital services tax. Budget 2021 proposed to implement a digital services tax, and as of Jan 1, 2022, as an interim measure until acceptable multilateral approach comes into effect, these rules have been implemented. And I'll use the word interim because it's not like the rules will go away, so to speak. It's more just these rules are here until there's a broader approach that's agreed upon multilaterally. The government's aim is to ensure that the revenue earned by large businesses, foreign or domestic, from engagement with online users in Canada through the collection, processing, and monetizing of data and content from users is subject to Canadian tax. Generally, the Digital Services Tax, or DST, will apply at a rate of 3% of revenue earned from certain digital services that rely on engagement, data, and content contributions of Canadian users. If you're looking for some examples of what this might include, this could include services provided through an online marketplace that helps match sellers of goods and services with potential buyers. One might think of Airbnb or eBay. It could include services provided through online social media platforms that facilitate interactions between users and user-generated content. And you might think of LinkedIn or TikTok here. Online advertising services, this could include interfaces such as online marketplaces, social media platforms, etc. And it could also include the sale or licensing of data gathered from users online. The proposed DST will apply to large tech-based businesses with global revenue of 750 million euros, yes, I did say euros, or more from all sources, and revenue of more than $20 million Canadian per year associated with Canadian users. The liability might be tax deductible in certain circumstances where it is incurred for the purpose of earning income subject to Canadian tax, but it would not be eligible for a credit against Canadian income tax payable. Each entity in a group will be jointly and severally liable for the DST payable by any of its group members. Therefore, multinational corporations should review their online presence and revenue streams to identify potential compliance, and tax exposures to prepare for the potential for this tax. And now I will pass to Clara Pham, back to Clara, to take us through trends in audit and enforcement.
Great, thanks so much, Austin. So a number of items come to mind when thinking about audit and enforcement developments in 2021. So first, as noted in the 2021 budget, the CRA continues to focus on tackling tax avoidance and evasion and eliminating the tax gap. What's the tax gap? Well, it's CRA's measure of the difference between the taxes that would be paid if all obligations were fully met in all instances and the taxes that are actually paid and collected. And according to the latest government information, the total tax gap to date is $24 billion. So in addition to that tax gap of $24 billion, consider that the current economic tally on COVID subsidy spending is about $100 billion so far, meaning that there was a perfect storm of economic pressure for Budget 2021 to propose more support for CRA's audit and enforcement programs, and also to revisit some of Canada's most important anti-avoidance rules. The main audit and enforcement programs from Budget 2021 are the mandatory disclosure rules and the enhancements to CRA's collection and audit powers that Stephen touched on earlier. So I won't spend any time repeating his thoughts, but will mention that there were other notable audit and enforcement measures that relate to consultations that government intends to hold on improving the transfer pricing and general anti-avoidance rules. Regarding transfer pricing, there is a perception that the current regime does not go far enough in protecting the erosion of the Canadian tax base. So specifically, it's rumored that new rules will be brought in that analyze the substance of the transaction rather than the form. In other words, we could expect rules that look to determine the arm's length nature of a transaction based on economic impact rather than legal form. And that would be a wholesale departure from the traditional Canadian transfer pricing approach that typically follows the form of transactions. Similarly, consultations are also being held on modernizing the General Anti-Avoidance Rule, or the GAR. Some proposals that have been put forward to finance for consideration include broadening the scope of the definition of tax benefit to include the creation of tax attributes and introducing a penalty where the GAR is found to apply. These are important changes because currently under the rule, the mere creation of tax attributes, or setting the table, as some call it, does not attract the GAR, since the definition of tax benefit generally turns on crystallizing or actually using an attribute. And even where the GAR does apply, currently no penalty is imposed, which can prompt some taxpayers to undertake aggressive tax planning on the basis that nothing ventured is nothing gained, because there's no threat of a GAR penalty. So broadening the definition of tax benefit and introducing a GAR penalty are both fundamental changes that would address some of the perceived failings of the current rule. So as for the topics that seem to attract audit attention this year, COVID subsidies are an obvious one. And as mentioned in more detail during the dispute session, other areas of federal income tax audit focus include the GAR and transfer pricing, of course, transfers of property for less than fair market value, shareholder benefits, trust planning, and private company surplus stripping. So overall, the update to note is that the audit lull we experienced in 2020 is clearly over. The next point is that there were some procedural audit tendencies that we observed in 2021. So CRA is still relying heavily on desk audits, and it's combining those more regularly with requests for information to compel the taxpayer or even third parties to produce information. These procedural trends, and together with some very broad information requests that are suggestive of fishing expeditions, make for an audit environment that appears to have gotten more aggressive. So for example, our clients are experiencing an important increase in the frequency and depth of audits, which aligns with this larger, more macro shift in Canada related to curbing tax avoidance and ensuring fairness among taxpayers. This more intense audit environment is not only a reflection of Canada's economic and tax policy mood, but also goes hand in hand with the subject matter of audit. CRA's tools of choice in 2021 were these broad, heavy-handed subjective rules like the GAR and transfer pricing that can be used to capture a range of transactions that CRA dislikes. So in short, CRA is upping the ante on all audit fronts, both substantively and procedurally. So now for some audit and enforcement predictions for 2022. I think we'll continue to see many of the same themes that were present this year. So anti-avoidance, transfer pricing, private company surplus strips, and COVID subsidies, of course. What is perhaps more of a novelty is increased attention to what I refer to as the trappings of the ultra-wealthy. So given the new rules and election promises relating to, for example, new taxes on luxury vehicles and boats and vacant housing or flipping, I think we're going to see increased audit activity around conventional and overt displays of wealth. And that goes for corporate entities as well, not just individuals' personal wealth. If proposed rules from the budget and election campaign platforms are any indication, we think certain entities like those engaged in extensive cross-border digital sales or large financial institutions, or multinationals with international dealings should be prepared for increased audits. So now on to COVID subsidies. I've indicated here on the slide some of the main programs that are still in effect. I'm sure you're all familiar with the wage subsidy and the rent subsidy if the applicant meets the required revenue declines. Then there is the Canada Recovering Hiring Program that is modeled after the CEWS, and that is a payroll subsidy, the amount of which is based in part on the employer's revenue decline. This subsidy would apply to employees that are hired in the period or whose pay is increased in the period when compared to prior periods. Then there's the Business Credit Availability Program, which guarantees loans for medium-sized businesses, which should allow those businesses to obtain additional credit. The Highly Affected Sectors Credit Availability Program provides low-interest loans to small and medium-sized businesses with a revenue decrease of at least 50%. And there are a lot of other COVID-related subsidies available, but keep in mind that we're seeing most of these programs either winding down or tightening eligibility. So for example, the revenue decline thresholds for the wage and rent subsidies have become harder to meet, and both subsidies are scheduled to end in October 2021, although the Liberals promised to extend them past October, but only for businesses in the tourism sector experiencing a minimum of 40% revenue loss. Another new important restriction on the wage subsidies since this summer is the executive compensation wage subsidy repayment rule, which requires public companies or subsidiaries of public companies to repay the wage subsidy if compensation for executives during 2021 exceeds the exec's compensation during the 2019 year. So by this time next year, I would expect most of the COVID subsidies to be wound down, meaning it would be worthwhile to review existing programs for the last few months of eligibility. And so now what can we expect in 2022 as the COVID programs wind down? Well, based on the election campaigns and in line with the increased attention on tax fairness, we might see some temporary levies on large corporations. The Liberals promised to introduce a corporate surtax of 3% on all bank and insurance company earnings in excess of $1 billion, and also to broadly review the tax treatment of large corporate owners of residential properties like REITs. And similarly, the NDP suggested introducing a temporary COVID-19 excess profit tax that levies an additional 15% tax on large corporations that received COVID-19 wage subsidies and paid out executive bonuses. The Liberals also threw in a promise that bank and insurance companies should be required to pay a special fee called a Canada Recovery Dividend over a 4-year period. The stated intention behind all these proposals is so that everyone gets a fair share of the profits that financial institutions gained while other Canadians tighten their belts and save through the pandemic. In 2022, we're also likely to see an extension to the CEWS and CURS programs. So as mentioned, the Liberals want to extend those subsidies past the planned October 2021 end date, but only for businesses in the tourism sector experiencing a minimum 40% revenue loss. And the subsidy rate will be up to 75%, commensurate with their revenue loss, to help cover fixed costs like wages and rent between September 2021 and May 31st, 2022. Now, the NDP want to go even further and provide both the wage and rent subsidies to small businesses until they are able to fully reopen. The Liberals also propose to extend the Canada Recovery Hiring Program until March 31, 2022. Similarly, the Conservatives vowed to introduce the Canada Job Surge Plan to cover up to 50% of the salary of new hires for 6 months following the end of CEWS in October 2021. And the NDP said it would introduce a long-term hiring bonus to pay the employer portion of EI and CPP for new or rehired staff. So basically, all this goes to underscore that the $100 billion spent so far on COVID subsidy programs will continue to grow. But clearly, government intends to balance the spending in two very pointed ways. First, by introducing new or higher taxes on certain privileged segments of the taxpayer base, and second, by strengthening its audit and collection practices. Jerry's been very busy scaling its audit teams and processes to recoup tax dollars that it considers were not reported due to abuse and avoidance. And I think overall, these intensified audit efforts are here to stay in light of Canada's national debt and the support that already has been allocated from government in the form of additional funding. So that concludes our year in review presentation today. Thank you.